So here's the Federal Reserve System today. You've all seen the Board of Governors building on the Mall. And here's the map of the 12 Reserve Bank regions. The map hasn't changed since 1914. That tells you something about the tyranny of the status quo. Right, the population has moved west. The 12th Federal Reserve Bank region now has about a third of the U.S. population in it. But the map hasn't been redrawn because that would shrink somebody's turf. Here's the Federal Reserve structure. The strings are a joke. On paper, it's decentralized. You have the commercial banks are nominally owners of the regional Federal Reserve banks. And so that gives rise to a lot of suspicion about who actually runs the Fed. But look, the ownership of shares is mandatory for commercial banks. It doesn't actually give them control over the Federal Reserve's policy. They're not allowed to sell their shares. They get a fixed rate of dividends on them. All it gives them is the right to participate in electing the board of directors of the Fed, and then the board of directors elects the regional reserve bank president, but subject to the veto of the board of governors, and most importantly, the budgets for the 12 regional reserve banks come from the board of governors. So the control is now at the board of governors. Monetary policy is conducted by the Federal Open Market Committee, which you see there sort of superimposed on the triangle. It's a combination of the Board of Governors and the 12 regional reserve banks. In particular, it's 7 members of the Board of Governors, if there are 7. Currently, there are only 5, plus 5 of the regional reserve bank presidents. And get down into the weeds. There are currently 2 vacancies. These are the 5 voting Reserve Bank presidents on the right. New York is always represented because that's where the financial market is. That's where the bonds are bought and sold to execute monetary policy. The other Reserve Bank presidents attend the Open Market Committee meetings and they talk, but they don't have a vote if they're non-voting this year. So the seats rotate among the reserve banks. So if we look back at the 100 years of the Fed, we can ask a pretty basic question. Has it been worth it? Has the Fed been a success? Well, the potential benefit that motivated the Federal Reserve Act was having a lender of last resort, to contain the problem of banking panics, the spillover effects of bank runs in particular. Well, the Fed didn't do such a good job of that in the 1930s, and so we got deposit insurance as a second try at trying to contain that problem. It did provide smoother seasonality to interest rates, or sorry, diminish the seasonality of interest rates. It did do pretty well at providing more currency in the fall and the spring so that we no longer got the spikes in interest rates the way we had before the Federal Reserve Act. So chalk that one up to them. I guess you could call that a kind of monetary policy. But if you're not going to have the gold standard control the quantity of money in the long run, we can evaluate how the Fed has done in its place. It's not going to look that pretty, but we'll get to that in a minute. There's a problem. There's a potential drawback of having a lender as last resort, and that's called the moral hazard problem. If a bank with inadequate reserves knows that it can go to the Fed and borrow reserves when it needs them, it's not going to be so careful about having enough reserves. Well, it depends on what price they can borrow them at. If they can go to the Fed and borrow them cheaply enough, there's no penalty for running out of reserves. So part of classical lender of last resort policy has always been, if you lend a bank reserves, make it pay. Charge a penalty rate. This was the advice given by Walter Bagehot, famous Victorian banking theorist who wrote about the financial market in Great Britain in a famous book called Lombard Street. But that's been a problem in the U.S. because the Fed has never been very consistent about lending at a penalty rate. In fact, it's chronically lent at a below market rate, which encourages banks to be a little lax about reserve management. It's even worse if you bail out banks that are fundamentally insolvent. That encourages risk-taking beyond prudent measure. Right? Banks not only don't manage their reserves well, they don't manage their whole portfolio well. If they think they're too big to fail, then they don't worry about spooking their depositors or their uninsured depositors. And The downside of monetary policy is, of course, when monetary policy is not well run. So in principle, the Fed could have outperformed the gold standard. In practice, it hasn't done that. It's had higher inflation, and it hasn't tamed business cycles. I'll show you some evidence on that in a minute, but if you look over the entire Fed's history, that includes the Great Depression. That's on the Fed's watch. So volatility in the economy has actually been higher in the last 100 years than it was in the previous period. Even though the National Banking Act did have problems, it did create the problem of the panics. But the Fed hasn't really improved on that. If you take out the Great Depression on the grounds that, well, that was just practice, right? The Fed was still learning. If you just look at the post-war period, it's about break even. Business cycles have been about the same amplitude as they were before the Federal Reserve Act, which is kind of disappointing because the economy is a lot more diversified, and you would think the Fed would be learning how to manage the economy better. And we did have the Great Moderation, but if you toss in the Great Recession of 2007 to 2009, and of course we're still below potential output by most measures, it now becomes break even. So let me talk about sort of the nuts and bolts of monetary policy, and then we'll come back to the potential for it to improve things and where it can go wrong. The potential, the objective of monetary policy is to control a monetary aggregate in order to accomplish some goal. So the goal might be low inflation. A lot of central banks have inflation targets. The goal might be to fix an exchange rate. A lot of central banks have a fixed exchange rate policy. It might be some balance, as the Federal Reserve's mandate is, between low inflation and real performance of the economy. By a monetary aggregate, I mean some quantity of money. And there are at least three important aggregates. M0 is the monetary base. That's the one the Fed directly controls. That's on their balance sheet. That's the Fed's liabilities. And there are two forms: currency held by the public and reserves held by banks. It used to be that the monetary base was about 90% currency held by the public and only about 10% bank reserves. Since the financial crisis, that's flipped. Not completely, but it's now about 75% bank reserves, used to be 10%, and only 1/4 currency held by the public. Currency held by the public hasn't changed much. What's happened through quantitative easing is that bank reserves have gone from 10% of currency to 3 times currency. They've gone from about 100 billion to 4 trillion. Sorry, bank reserves 3 trillion out of 4 trillion.